All right, thanks for being here. I'm Sham Gad. I'm the CEO and Chairman of Paragon Technologies. I actually did this presentation, I think, five years ago in 2019. I've known Robert for a while, and he reached out. So we'll jump in it. Feel free to ask questions during, but I'll run through the slides fairly quickly because I enjoy the Q&A portion. So we'll get to it and go from there. So here's our disclosures that you saw. So about Paragon, right? So we're a holding company. We own subsidiaries that engage in diverse business activities. Currently, we have 3: automation, distribution, real estate investment, and then we have ownership of a portfolio of marketable securities as a way to sort of invest our excess cash. And so obviously our goal is to obviously grow our existing businesses, but truly it's to acquire other additional businesses. So we'll diversify and grow our revenue stream and cash flow to support continued acquisition. So unlike here, we not one specific business per se, but that's what we're trying to do. So these are 3 subsidiaries. One's in supply chain automation, SI Systems. That was our first one. That's what Paragon had. And then when I got on board about 10 years ago, we started the holding company and making the acquisitions. Then we own SCE International v. Columbia. It's an IT hardware and services distributor in Latin America. It's a gem of a business. And then Ohana Home Services, we own some real estate assets actually here in the Las Vegas market. So, all right, so real quick again about SI. It's actually been around 65 years or so. So it's a niche provider of automation. So in terms of that, we are a leader in that space. We're U.S.-based, U.S.-made. We have actually over 65 years of operating history now. And so supply chain automation. So we work with warehouses and manufacturing facilities to go in, obviously, automate their order fulfillment centers. So we provide the hardware and the software and the systems integration to move with those warehouses. So like I said, we've had a proven track record of innovation. Obviously, in the 60s, 70s, 80s, and 90s, I mean, SI was pretty much blazing the path. Interestingly enough, I think it was about 2000 or so, well before my time, SI owned, what's now probably one of the largest conveyor suppliers in the United States, but they sold it off. So, but we have a great little business. It really provides some value-added services to a lot of key suppliers. That's one of the things that we really love about this business is our installed customer base and the new customers we get, because automation, as you know, is not going anywhere. But as I say, we're a niche supplier. In other words, what we do now is just offer certain solutions that go as part of an overall automation system, right? So automation systems now, if you go into these warehouses, they're conveyance, they're shipping and packing stations, they're moving stations. So our goal is obviously to leverage sort of our brand and the customers we have and our products to get us more into the systems integration. And that's sort of our growth path for this business, is to now become, a small systems integrator. We're not interested in the Amazons and Walmarts of the world, right? Those are being taken care of by Dematic, Schaefer, which are the big industries there. 80% of warehouses sort of fall into this 50,000 square foot to maybe 500,000 square foot space, which, these businesses, they're looking for small systems integrators that can come in and really provide a turnkey solution. And what that basically means is you're not doing all those things, but you effectively have the relationships and the partnerships, and more importantly, the intellectual talent to go in and evaluate an automation need and say, yeah, we'll design this whole system for you. And you bring in the right direct partners to put the pieces together, but your value add is the integration, the software. So it's pretty exciting opportunities for us there. So yeah, so what we do is beginning to end. I sort of talked about this, right? We provide the software integration, system design, all the things that clients will demand before they invest millions of dollars in automation systems. So our 2 key products, and they're both tops in the United States, are production and assembly, which is sort of the legacy business of SI. That's what it was founded on back in the 60s and 70s. And for a while, I actually thought this was just sort of the cash cow type of division, and it is. But in recent years, we continue to get some new opportunities from some major manufacturers. So if you think about tow line heavy conveyor, just think about businesses like Caterpillar, these industrial, or even the U.S. Post Office, these industrial type that are moving heavy products through their facilities as they assemble them. We provide the in-ground conveyance system, which provides a lot of safety, a lot of labor efficiencies for those companies to sort of move their manufacturing assembly lines through and get it done. Distribution and logistics, this, I guess is where most people, when they think of automation, as it should be. So, our A-frame robotic order picking. So this is designed for high-speed order fulfillment centers. So these would be warehouses that are, doing, thousands of orders a day, hundreds of thousands of orders an hour, hundreds of thousands of orders a day, right? What they're broken case picking. So e-commerce companies, our sweet spot is healthcare and pharmaceuticals. So if you think about, pharmaceutical business with all their products, whether you're ordering direct or they're selling to retailers, right? I mean, they're pushing out a lot of orders, and you'd be surprised at how many are still manual. They're manual operations, right? You're going into these warehouses and they have hundreds of people, pulling inventory, order tickets from computers, walking over to shelving, getting the orders, putting them in boxes, putting them on conveyance. What the A-frame does is it basically allows these fulfillment centers to, push out as much as 400 to 4,200 orders per hour. So, in terms of what it does, it remains the fastest picking solution out there. I mean, all these robotic arms that you see that, are obviously sexy and have their need, I mean, they're just, if you want high speed velocity, the A-frame does it. So it's an excellent product because it gets us in the door to a lot of opportunities. And what we're seeing, it goes back to my earlier comment, is most of these facilities, they usually want to spend, several $1 million or even more automating a whole system, whereas the A-frame is part of that system. So, what we're trying to do is go in there and instead of capturing one or two slices of the pie, to get more of the pie because the margins are higher. It's also what we love about order fulfillment. We have a recurring revenue model because the relationship starts once you install the system, because from then you have these annual maintenance and software support agreements. So we've got clients and businesses we've been with for 20 years that, we install the systems, they need maintenance and repairs, but we continue to generate recurring revenue from the maintenance and software support. So obviously, stuff you kind of already know. I mean, we're in an industry that's just not going anywhere. And this slide actually, I think, was put together in the 2019 presentation, but I left it because it's even more acute today, right? So pre-pandemic, you had companies with the labor issues, and it wasn't going anywhere. But post-pandemic, it's even become more severe because, they just can't find individuals that want to do necessarily those types of jobs, right? And with automation, there's no turnover. You don't have anyone calling sick. So they're really, the value of automation is just going to continue to sort of reveal itself to these businesses as they realize they can do more with less, and they don't have to deal with the burdens of, of maintaining an unnecessarily labor force. So, but it adds, it takes a lot of sort of, the manual monotonous labor and shifts it into, higher, more technical positions. So, and believe it or not, the vast majority of warehouses are still have no automation. So there's definitely tailwinds that we expect to continue for quite some time. And this is just a snapshot of some of our customers. So for a small automation company, you can see that we've done business and we continue to do business with Fortune 100, Fortune 500, and all the way down to the small and medium-sized business. So SCD International Colombia. So it is one of the top IT distributors in the country. We have our main space in Colombia, in Tocacapancia. We were in Bogota, but we moved, and so SCD has been in the market again, over 20, 25 years. It's top 20, 25 IT companies in the country, top 5 of the IT distributors in the country, and so we have a workforce of 130 growing strong, diverse customer base. So it's interesting because now SI Systems, as you can imagine, it's a business with very specialized systems. They take time, very, very high margin systems. Whereas distribution, it's a lot of high volume, low gross margins. And I got to tell you, it's actually, they're really good businesses because they're hard to run well. And what's made this work for us is one of the conditions I had when we acquired SCD was there's an individual that actually founded it and ran it, and he had left. But, bringing him in to run the business was sort of, it had to happen. And he came on board, and we actually acquired 80% of the company. He took 20%, and it's just been a wonderful, wonderful relationship, marriage. But he's really taken the business to the next level. But they're very, you talk about distribution, and you look at it, and yeah, we move IT boxes, right? But essentially, any good distribution company, it's a finance business. Like, you have to know how to purchase your inventory right. You have to know how to move it right. You have to, you add value to the customers. Obviously, it's a price-sensitive market, but they trust reliability, dependability, and that's the key. I mean, with high volume, low margins, if you do things right, the smallest improvements, as you'll see, can really magnify your business. On the other hand, if you're not disciplined and you're not paying attention, it can really harm the business. So, but they're consistent, right? We're selling, sometimes hundreds of thousands, millions of dollars a day in product, and you really got to know what you're doing. And we just have an exceptional team, and it's been a phenomenal acquisition. And we serve the major technology vendors. So in Colombia, we are the number one distributor, or number two for Hewlett Packard. We're top 3 or 5 with all the major ones: Lenovo, Dell, and so obviously the distribution industry, especially in IT, is such that the vendors, they're not in the business of distributing their products. They're in the business of developing and investing, creating new products. And then but they also want more than 1 or 2 distributors in the market. No vendor wants to sort of hitch their wagon to 1 or 2 distributors. So they're very interested in making sure there's a diverse amount of distributors out there. More importantly, what they prize is how many customers we touch. And that 25+ number, that's truly our customer base over time, and it's growing. So yeah, the value proposition of the vendors, the distributor, give them access to fragmented markets, right? I mean, we're the ones that are out there exposing them to all these resellers, right? We penetrate vertical markets. We have what I believe is a really top-notch logistical team. I mean, we're just on top of things. Our inventory stays really crisp and fresh because there's a lot of functional obsolescence, as you can imagine, in IT distribution. And obviously, it's technology. So you're sort of moving along with the industry, right? I was just at a HP conference recently here, and as I'm sure you all know, all the buzz is about AI and AI embedded, computers and what have. So for us, all that means is, as companies and markets and institutions start to refresh their cycle, that's going to really bode well for us. And we serve government entities down in Latin America. We serve, educational as well as, the private markets. And obviously, we have a really good, product availability. We're always good there. Multi-vendor solutions. We have financing options to some, vendors. Obviously, we issue credit to them. So again, all those little things, like so many little inputs come together that are just so important. I think that's sort of that's like the advantage. You don't think of high volume, low margins businesses as being, great businesses, but if you do it right, you just can't do it. I mean, if I offered any one of you, even $5 or $10 million and said, go out and create one of these businesses, I mean, you would be remiss to even do it for probably 3 times that amount. Vendors are very specific who they want to work with. They want to know that you have access to the markets, and you got to develop credit and relationships. So it's been a good thing for us. So again, and so we have a balanced portfolio within SCD. Obviously, we have what we have is a transactional division, which is more consumer, retail, reseller. So again, high volume, the lower gross margins, and you think about the notebooks and the PCs. We have the value, which is the large enterprise projects, government bids, right? So you think about going into, these governmental entities, educational businesses, and they want you to outfit the whole thing. So we do that. Again, those, balance the margin with higher margin. And then obviously we migrated recently into the managed services, as you can imagine, with IT. Right now, the company they're just not calling you and saying, hey, I need 3,000 printers and servers, but I want you to come install it, provide the networking. And so it's a really interesting business, and I've learned a lot from it over the past 6-7 years that we've had it. So moving forward strategy just to continue doing what we've basically been doing. And again, obviously I think in distribution and technology and what we do, there's always growth opportunities. The key is that, we remain relevant. We're disciplined. We're not going to make bad business deals just to grow the top line or even the bottom line. And so it's kind of, it can kind of have moments like the insurance industry, right? When there's a lot of product or credit conditions are easier as they were before interest rates went up. There are a lot of competitors out there that were, selling less, lower prices, and we'd avoided that. And it's, gives us long-term credibility. So Ohana Home Services is our third division. That's started in 2017, basically just through the acquisition of some real estate assets here in the market. So what Ohana owns now is basically several luxury condominiums in the 5-star Waldorf down here. For those of you who aren't from here but are coming here, I mean, Vegas is really becoming a city to pay attention to. There's still people obviously that consider it gaming and that, but it's not anymore. I mean, you still have that element, but the vast majority now of revenue is being generated from the entertainment, the dining. In 2019, when I stood up here, right, I think all we had was the hockey team, maybe, right? I think we had the hockey team. If you look at it now we have an NBA team, championship hockey team. We have the NFL. Certainly in the next several years, you're going to get an NBA team, and there's talk of a Major League Soccer team coming. I was reading something the other day, and I think there's only like 13 cities in the entire country that hold the 4 major franchises, right? NHL, NBA, NFL, and MLB. Sadly, they don't consider soccer a major sport yet in this country, but I think it's coming. But Vegas is on its way there, right? And not even that. Besides the sports, the CES conference that was here this earlier year, Consumer Electronics Show, like several days after that, articles in the paper were popping up about all these technology parks opening up and the migration from California, not only now just from retirees, but like entrepreneurs and individuals that are coming here and wanting to set up their businesses because of the favorable tax environment, the low cost of living. So obviously for me, I believe that's a tailwind to quality real estate. And, and so in 2019 and 2020, we did 2 more deals in that same building. We acquired 2 additional units. The kicker on that deal was that the seller wanted to finance. He wanted to get out. And so I knew him. He was a good businessman, but he just had to, he had to diversify his portfolio, but he financed pretty much 80% of the deal at 0% for 3 years. And so it was great. I mean, for him, obviously 2 years ago, but as you can imagine, as interest rates went up, that financing was really advantageous to it. So, but yeah, I mean, we're sitting on assets that are worth certainly a little bit more than they are now, and the rents are generating strong free cash flow. They're growing at fast rate of inflation, and that's a luxury asset, and we like those because we think they're a little more insensitive and immune to sort of market fluctuations because those individuals that look at these opportunities tend to have a little more resiliency. So here's a financial snapshot of Paragon. This is consolidated, so this is everything. So I could take you back before 2020, but I think in 2017 is when we made the distribution acquisition. But as you can, it's been a good run. So I mean, the revenues have been growing. We're profitable, and there's earnings per share and equity. And I will tell you, we're also, as you'll see in other slides, we've done all this with, I think, less than 5% dilution. I think we only have 1.7 million shares outstanding. So I'm the largest shareholder. We're a small business, but we hopefully want to scale and grow and obviously, get out of the MicroCap space one day soon. But I think for us, in order to do that, we feel the way we're going to do it is through continued acquisitions of businesses. We understand or can at least, see, 5 or 10 years out that'll continue to do well with people we want to work with and want to run those businesses. And so, all these numbers have occurred without any external financing or doing anything like that. We've just basically kind of run a very good, efficient company, and we care about performance. And this has been our scorecard, obviously, since then. So it's been, slow and steady wins the race, right? That's sort of, my mantra. We're not here for anything quick. I mean, we're going to do what we do, and hopefully over time, as we create value, that happens. Obviously, taking a little dip, but that's really of no concern to me in the short run. And this is just a little bit of our acquisition criteria, and so we want businesses that, we see a demonstrable track record of revenues and positive operating earnings, or the ability to do that more so under Paragon. So when we acquired, SED company, it was doing about, 40-50 million in sales, and that's almost doubled now in the past 5 years under Rennell, the guy that runs it for us, and sort of our operating culture. And so preferably, these are businesses that have management teams in place, just for the initial transition in. And we're after long-term partnerships, right? We're buying for keeps, right? We're not a private equity firm. There's no exit strategy here. We want to buy these businesses, as I said earlier, so we can add our operating earnings and grow our revenue stream. And right now, our deal business size, companies going to have operating earnings between 1 to 5 million, just generally speaking, depending on the valuation when you add to them and our ability to acquire them. And then, like I said, we move quickly if we like what we see, and it's clean and transparent. Like, we're not trying to create complicated deals or anything like that. So obviously, I'm always interested to see what's out there, and feel free to shoot us a line if you have anything. So this is a little bit sort of our culture, right? So we made these acquisitions that we believe have added significantly to the business intrinsic value and earning power. We're always going to possess a strong balance sheet. It's important to me that we control our own destiny. What's the saying that, a banker gives you, dealing with a bank is like giving you an umbrella in the sunshine, then they want to take it away from you when it rains, right? So we want to be in a position when times are tough, we're able to, manage our business and make our own decisions and not feel like we're under any duress. And so we're always going to possess a strong balance sheet. We're very long-term focused, so we don't do conference calls. We're not going to provide quarterly estimates. Those are distractions that take us away from what we do. And I think it adds to our advantage because our managers appreciate that, right? My conversations with them are not, how's next quarter looking or how's next month? What are you thinking about the business? What are our thoughts over the next, what are our competitive advantages? What is the competition doing? How do we continue to add value over the long term? And because of that, we truly do view our shareholders as long-term partners. We have quite a few that have been shareholders 5 or 6 or 7 years, and they understand our culture, what we do. I publish an annual letter every year that, really goes into detail about our business, and so it's something we're proud of. And, I own 30% of the business, and almost all those shares have been acquired in the open market over time at prevailing prices. So eat our own cooking. Obviously, the company and our shareholders know when we do well. Obviously, I stand to do well, but if we experience any pain, then I'm right there alongside with them. And I think that's an alignment of interest that I think is very important. It's very important to me, and I think our investors and shareholders appreciate that. So that's it. Thank you for your time. I don't know how much time we have. 5 minutes. I apologize, but I'm open to any questions, and I'll be around for a few minutes to chat with anyone who wants to have a conversation. Yes, sir.
So on the financial side of something, can you just talk about what happened in 2023 with the numbers?
Yeah, how do I go back? Anyways, yeah, so the decline, the sales, obviously, is there a way to go back on this? Yes. Right here. So, I mean, from a revenue standpoint, I think most of us, especially in our businesses, right, coming out of the pandemic just was a boom to a lot of businesses, right? There was a lot of, so I say that because I think it's reasonable, as most businesses saying, if you're looking at the revenue line, to somewhat compare it to 2020 and 2019. Now, obviously, we hope over time we're going to eclipse the 2021 numbers, but if you think about from our IT distribution side, right, you have the pandemic in 2020, you have this migration of hybrid work, people working, so the demand and need for IT products, laptops, servers, I mean, it went through the roof. And so that really led a lot of the growth in 2021 led, from the distribution side, right? There's a pent-up demand for all that, and it stayed for a long time. We were also in a period of low interest rates, zero interest rates, obviously, and it was the same way in Latin America. To my point earlier about the finance team, I mean, we started using our balance sheet to prepay for products, and we were getting better deals, better pricing. So automation was the same way, right? The pandemic led to this labor crunch. You had a lot of businesses obviously wanting to automate, and they also had money to spend, right? Small businesses were getting funding from the government, and so it led to a couple good years. So really the decline in revenue was mainly through the distribution side, which is of no concern to us. I mean, it's, we knew that cycle had to take a break. The net income decline was partly due to that. We had an increase in SG&A through some investment activities we were dealing with, but we'll go through moments like this. We never expect to have a line that goes like this, but like I said, the company is run by owners who are acutely, our upside and downside are acutely tied.
Rates go higher in technology.
Well, it's in terms of the financing, yeah. I mean, but it's been good, and I think we're off to a good start this year. So.
Yeah, but I mean, because the background margin, your inputs took a hit, that was much more than the revenue. So I'm just curious if you had some costs, you mentioned investment. Is there something that kind of, as you go into 2024 here, that is not being extended that was last year?
Yeah. Like I said, we were involved. We were dealing with a potential acquisition opportunity, and so it's most of those costs are sort of baked into that. So, Yep. Great question.
And did you say what balance sheet looks like? Sorry, I missed that.
Yeah, I mean, there's the shareholder equity. So I'd say it's, probably close to, between our cash and the investment portfolio, it's probably $7 million unencumbered. The automation company has no debt, and the distribution company, its only debt is, obviously it has its own debt on its balance sheet, obviously to fund the purchase of products. So.
And acquisitions, do you fund them with cash flow?
Yeah, typically, like when we bought the distribution business, we paid for it 100% cash. So that's our preferred preference. Obviously, if we find the right deal and the right, prudent use of leverage, we'll do it. We'll do it every time, right? But we're not going to over lever or take any risk that would, harm the business in a way that we couldn't get out of. So. Any more questions? Thanks, man.